Recent tensions in the Middle East have unsettled global markets. While oil prices have moved higher, both shares and bonds have experienced volatility. In times like these, it's only natural for investors to feel concerned. But while the headlines can be confronting, history reminds us that perspective matters. Right now, markets are reacting mainly through energy prices. Concerns about possible supply disruptions have pushed oil prices higher, which can influence expectations for growth, inflation, interest rates, and something as broad as investor sentiment. Importantly, markets appear to be repricing near-term risk rather than signaling a lasting change to long-term economic fundamentals. Markets have responded, yes, but not in a way that suggests fears of a sustained shock to growth. The Middle East plays a critical role in global energy supply, and concerns about future escalations are absolutely reasonable. That said, markets tend to recalibrate as situations become clearer and extreme outcomes might fail to materialize. Even when uncertainty remains elevated, the reaction of markets to geopolitical events is often sharper than it is lasting. Periods when both stocks and bonds decline together can feel especially uncomfortable. Historically, these environments are often linked to inflation concerns or a sudden repricing of risk, and they've typically been transitional, not permanent in nature. And geopolitical events have rarely changed long-term market direction unless they lead to prolonged energy disruptions, significantly tighter financial conditions, or a broad economic downturn. When those outcomes don't occur, markets have generally recovered, even if tensions persisted for longer. For investors, a few principles are important to keep in mind. First, diversification matters greatly. It may not prevent short-term losses, but it supports resilience over time. Second, discipline is critical. Volatile markets can tempt investors to react emotionally and often at the wrong moment. As we see in this chart, based on the example of the 10 best and 10 worst performing days of a global developed equity market since the year 2000, the days with the worst performance often fall closely together with the days with the best performance. Now, missing out on those few days with great performance, which may happen to investors that hectically divest after drawdowns, can be detrimental for long-term performance. In fact, missing out on just the best performing 10 days since the year 2000 would have cut performance into more than half, as we see on this slide. Hence, staying the course and sticking to a long-term investment plan are very important drivers of investment success. And volatility may even create opportunity, particularly for investors that rebalance or reinvest new money in line with their long-term goals. Periods when both shares and bonds are under pressure are quite unusual, but they remain a normal part of investing. While near-term volatility may continue, long-term outcomes are still driven by fundamentals like economic growth, inflation trends, and policy credibility. Investors who remain disciplined, diversified, and who focus on their long-term objectives have historically been best positioned to navigate uncertainty and to participate in future growth.